Hey everyone, welcome back for another deep dive. Today we're tackling the recent Federal Reserve announcements. And, the markets, they reacted in a pretty unexpected way.
Yeah, it was definitely a head scratcher.
Usually when the Fed lowers interest rates, everyone's popping champagne.
Yeah.
But this time, it was like someone pulled the fire alarm, the S&P 500. It took a nosedive, a biggest drop since March 2020.
Nearly $2 trillion just wiped off the market cap.
Poof, gone. So we got to figure this out. We've got the Fed's press conference transcript, some interesting market observations. Well, let's see if we can unravel this mystery.
The funny thing is the rate cut itself wasn't the shocker. Most people saw it coming.
Really?
Yeah, it was more about what Powell, the Fed chair, said about the future. Like, at their outlook for 2025, that's what really got people spooked.
Okay, so let's break this down. First, what exactly did the Fed do? Like, what's the deal with these rates?
So they lowered the target range for the federal funds rate by 0.25 percentage point.
Okay.
Bringing it down to 4.14 to 4.12%. Now, that might not sound like much, but it actually adds up to a full percentage point reduction from its highest point. And, the Fed, they're always trying to balance things out, right?
Fiscal mandate, yeah.
Exactly. Maximum employment, but also stable prices. It's like walking a tightrope.
So they cut rates to kind of juice the economy a bit, but the market's freaked out. That doesn't add up.
Well, see, the markets, they already factored in this rate cut. What they didn't expect was the Fed kind of hinting at being more hawkish, for 2025.
Hawkish meaning?
Less likely to cut rates. At first, they were talking about 3 rate cuts for 2025.
Okay.
Now, they've walked that back to just 2, which would only be a 0.5 percentage point reduction. And get this, one Fed official even said there shouldn't be any cuts in 2025.
Whoa, no cuts at all.
Yeah, pretty drastic. And only 5 officials out of the whole bunch think there'll be 3 or more cuts that year.
Wow, okay. That's a big shift. Sounds like inflation is the big elephant in the room here.
Yeah.
So what's the latest on that front?
You got it. Inflation is the uninvited guest that just won't leave, and it's making the markets super jittery. Just look at the numbers. 3-month annualized core CPI inflation back up to 4%.
Oof.
Yeah, and core PCE inflation that's also sneaking back up could hit 3.5% or even higher. Even the Producer Price Index, PPI, which tracked wholesale prices, it's showing some signs of life, too.
So inflation's back with a vengeance, and investors are hitting the panic button. I can see why.
Exactly. And Powell, he didn't really help matters when he said that deciding on this rate cut was a closer call than usual.
Closer call, huh?
Yeah. Just those 2 words sent shockwaves through the markets. The U.S. dollar, it jumped up, highest point since last November.
It's crazy how a few words from the Fed chair can move mountains. But wait, didn't someone on the Fed actually disagree with this rate cut?
You're right. Beth Hammack, the Cleveland Fed president, she dissented.
Now, that's not something you see every day.
Yeah.
Is there trouble brewing in Fed paradise?
Well, it definitely shows that not everyone at the Fed is totally on board with the way they're fighting inflation.
Interesting. So we've got inflation worries, a more hawkish Fed, and now internal disagreements.
Yeah.
No wonder the markets are going haywire. But you mentioned this new phase of monetary policy. Can you explain that?
It boils down to this idea of the neutral rate.
Neutral rate.
Imagine the interest rate sweet spot, the rate that neither speeds up nor slows down economic growth.
The Goldilocks rate.
Exactly. Just right. But here's the thing. Finding that rate in real time, it's like trying to catch a greased piglet. It keeps moving.
Always shifting, yeah.
And that's what the Fed is dealing with right now. They're in uncharted territory trying to find this elusive neutral rate.
Okay, so lots of uncertainty. But what does this all mean for everyday folks? How does this new phase actually affect things like mortgage rates, car loans, credit cards?
That's the million-dollar question, isn't it? It's worth thinking about how this new phase could impact different parts of the economy and what it means for your own financial decisions in the coming year.
Definitely something to keep in mind. But before we dive into those implications, I want to touch on something you mentioned earlier, the market's reaction, especially in the crypto world. We talked about stocks tanking, but what about crypto? How did Bitcoin and other cryptocurrencies react to all this?
Well, that's where things get a little more interesting. While stocks were taking a beating, crypto, it kind of held its own, at least at first.
Really? That's surprising. Why do you think that is?
It's hard to say for sure. Maybe crypto investors are just used to wild price swings. Volatility is kind of baked into the crypto world. Or maybe, just maybe, they saw something in the Fed's announcements that gave them a glimmer of hope.
Now you've got me curious. You mentioned Powell's take on Bitcoin earlier. What did he have to say about crypto, specifically Bitcoin, during the press conference?
Yes, the Bitcoin question. It's a hot topic, especially with all the crazy price action we've seen lately. And Powell's response was, well, it was interesting.
Did he hint at the Fed buying a bunch of Bitcoin anytime soon?
Not really, no. He basically said the Federal Reserve Act, as it stands now, it doesn't let them own Bitcoin. And he didn't sound too keen on pushing for changes to that law.
So the Fed isn't jumping on the Bitcoin bandwagon just yet. But what about the U.S. government holding Bitcoin reserves? That's been a hot topic lately. Did Powell weigh in on that at all?
He did touch on it, and he made it clear that any decision about the U.S. holding Bitcoin reserves, that's up to Congress, not the FOMC. They'd need to change the law for that to happen.
Interesting. So Congress holds the keys to the Bitcoin vault. But what are the chances of that actually happening? And what would it mean for the U.S. economy, the global financial system? I mean, that's a whole other can of worms, right?
Right. Oh, absolutely. That's a question that sparked a lot of debate. And you know what? That's exactly what we're going to unpack in the next segment. Stay tuned. The idea of the U.S., holding Bitcoin reserves, it's definitely a fascinating one. It's like this whole debate, people on both sides, super passionate.
Okay, let's unpack this. What are the potential upsides? And of course, the downsides of the U.S. diving into this Bitcoin pool, so to speak.
Well, on the plus side, people who are pro-Bitcoin, they argue that holding Bitcoin reserves could be a good hedge against inflation
Makes sense.
because, Bitcoin supply is limited. Unlike, fiat currencies, dollars, euros, they can be printed endlessly. So the thinking is Bitcoin's less susceptible to inflation.
Interesting.
They also say it could actually strengthen the U.S. dollar's position globally.
Really?
Yeah, by kind of aligning it with, a cutting-edge decentralized asset.
I could see the appeal, especially with inflation being such a pain point. But what about the risks? Bitcoin, it's not exactly known for being stable.
Right, that's the big one for the critics. Bitcoin is volatile, like super volatile. The price can go up and down like a roller coaster.
Yeah.
And if the government's holding a ton of it, well, those swings could be a real headache. Then there's the whole regulatory thing, right?
Right.
Cryptocurrencies, they're still kind of in this gray area, legally speaking. So there could be some hidden risks for the government there. And let's not forget, Bitcoin's also been linked to, illegal activities. That's a big concern for policymakers everywhere.
Yeah, it's definitely a decision with a lot of moving parts. But ultimately, it's Congress that needs to make the call, right? Not the Fed.
Exactly. It's a legislative matter, not a monetary policy decision.
Yeah.
It will require changes to the Federal Reserve Act, and that's Congress's territory.
So we'll just have to wait and see on that one.
Yeah.
But let's go back to the Fed's announcements for a sec. We talked about how the stock market reacted, but you said crypto was a bit different. What exactly did we see in the crypto markets, especially for Bitcoin, after these rate cuts and the Fed's, more hawkish stance on 2025?
It was kind of a mixed bag, to be honest. At first, Bitcoin and other cryptos, they seemed to handle things better than the stock market. There was even some talk that the rate cut, even though it came with those hawkish signals, might actually be good for crypto.
Really? How so? Why would a rate cut, even a small one, be good news for Bitcoin?
Well, some analysts think that lower interest rates make riskier assets, like crypto, more attractive to investors.
Okay.
Because when rates are low, the traditional stuff, bonds, savings accounts, they don't pay as much. So people might look for bigger returns, even if it means taking on more risk.
So kind of like, hey, rates are low, let's get adventurous with crypto.
Something like that, yeah. But here's the thing, that initial bump, the excitement in the crypto market, it didn't last.
It faded.
Yeah. Once the reality of the Fed's, hawkish stance on future rate cuts sunk in, Bitcoin, other cryptos, they started to feel the pressure.
So the party was over pretty quickly. What's the outlook for crypto now with this tighter monetary policy?
Yeah.
The Fed laser focused on squashing inflation.
That's the million-dollar question, isn't it? Some analysts are saying that if the Fed keeps, tightening the screws, so to speak, it could put some downward pressure on crypto prices. Because a stronger dollar, a less risky investment climate, that might make crypto, which is seen as, high risk, high reward, less appealing.
So even though crypto operates in this whole decentralized world, it's not immune to what's happening with traditional monetary policy.
You got it. They're connected. And that connection, it's probably going to get even stronger as we move into this new phase of monetary policy.
Chris, you think?
Whatever the Fed does or even hints at doing, it creates these ripples, and those ripples, they reach crypto too.
Sounds like uncertainty is the theme of the day for both traditional markets and crypto.
You said it. We're in a period of transition. For monetary policy, the global economy, everything, the old playbook, it might not work anymore. We're all trying to figure this out together.
Okay, so before we start speculating about the future and what this all means for our listeners, let's do a quick recap. The Fed cut rates, but they also kind of hinted that they're tapping the brakes on future cuts because inflation is still lurking in the shadows. That freaked out the markets, stocks took a tumble, and even crypto, which usually shrugs these things off, felt the heat. We also talked about the U.S. potentially holding Bitcoin reserves, lots of interesting arguments there, but that's a decision for Congress to make.
Great summary. And it leads us perfectly into our next discussion, where we'll put on our futurist hats and explore some potential scenarios. We'll also offer some insights to help you, our awesome listeners, navigate this ever-changing economic landscape and make smart decisions about your financial future. So stick with us.
Okay, so let's get our crystal balls out and try to see what the future holds. We've got this new phase of monetary policy, inflation's still a wild card. What are some possible scenarios, good and bad?
Well, let's start with the, let's say, not so fun scenario. What if inflation, doesn't play nice?
Doesn't play nice, meaning?
Yeah. Meaning, it's even worse than the Fed is predicting. Remember, they already bumped up their inflation projections for 2025, but what if they're still too optimistic?
So inflation throws a wrench in their plans.
Right.
Then what?
Well, the Fed might have to keep raising rates, even if it means, slowing down the economy. It's a tough choice. But they might see it as the lesser of two evils.
And that would mean?
It could mean what economists call a hard landing. Basically, a pretty sharp economic downturn. Think rising unemployment, businesses struggling, maybe even a recession.
Okay, that's definitely not the scenario we want. Let's try the other side of the coin. What if inflation actually starts to chill out, like the Fed is hoping?
That would be the ideal situation, right? In that case, the Fed could keep gradually cutting rates, supporting growth without, reigniting the inflation fire. It'd be what they call a soft landing. Inflation goes down, economy keeps growing, unemployment stays low.
Okay, so we've got hard landing, soft landing, two very different paths.
Yeah.
But it feels like a lot could happen between now and 2025, let alone 2026.
Oh, absolutely. There's so many things that could happen. Geopolitical events, supply chain hiccups, even changes in how people spend their money. Any of these could throw the Fed's plans completely off track.
So how do we even navigate this kind of uncertainty? It's like trying to walk a tightrope in a hurricane.
The key is to stay informed, be adaptable, and focus on managing risk. Think of it like being a good sailor. You got to read the winds, adjust your sails, and be ready for rough seas.
Okay, I like the analogy, but break it down for us landlubbers. What does staying informed and adaptable actually look like in real life?
Staying informed means going deeper than the headlines, right? Dig into the economic news, get different perspectives, try to understand what's really driving things. And hey, you're already doing that by listening to the deep dive.
Always got to plug the show. But information's only useful if you use it, right? That's where the adaptability comes in.
Exactly. Being adaptable means being willing to adjust your plans. Maybe you tweak your investments, change your savings goals, even switch careers if things shift drastically. The world's changing fast, and we got to be able to change with it.
And what about managing risk? Any tips for surviving the economic storms?
Don't put all your eggs in one basket. Diversify your investments, spread out the risk, have an emergency fund, for a rainy day, and be careful about taking on too much debt. These are all good rules of thumb, always, but especially when things are uncertain.
So stay informed, be adaptable, manage risk. Got it. But beyond those practical tips, what's the big picture takeaway here? What should our listeners really be thinking about as they navigate this new economic reality?
I think it's important to remember that economics, it's not just about numbers and theories. It's about people. It's about how we make decisions, how we work together, how we create value.
That's a good point. We're not just watching this economic show from the sidelines. We're all part of it. Our choices matter.
Absolutely. And that's something to keep in mind as we wrap up this deep dive. The future might be uncertain, but it's also full of opportunities. If we stay informed, stay adaptable, and make good choices, we can navigate this new landscape and create a better future for ourselves.
Well said. And on that note of optimism, that's a wrap for this episode of The Deep Dive. Thanks for joining us on this exploration of economics and finance. Hope you learned something, had some aha moments, maybe even started some interesting conversations. Until next time, stay curious, stay informed, and stay engaged.